Welcome to this quick video on the focus on income. My name's Garry Davis and this is general advice only. All right, what is income really? Because there's been a massive surge of late in the coverage of the subject of income and how you can derive income. Now, Australians traditionally have had this fixation with franked dividends and income stocks. And I want to explore whether it really is a smart investment or whether it's just a product of long-term conditioning that we default automatically to Telstra or the banks or something of that nature. And in my view, as I'll show in this video, I think there are far, far better investments. And if you look at the banks, CBA has done relatively well compared to the rest, producing a total return, capital gain plus dividends, of around 14% per annum over the last 5 years. But if you look at the rest, Westpac sits at about 4%, NAB about 10%, and ANZ in the middle at about 6%. So that's hardly earth-shattering returns. And if you consider what the real rate of inflation is at the moment, I think a lot of investors aren't even keeping up with that. They're actually going backwards with this fixation on just fully franked dividends. But are there other ways to do it? And as an example, would you prefer a 20% long-term total return, so that's more heavily capital gain orientated with perhaps a bit of a dividend, but nevertheless, total return 20% per annum over the longer term? And there are certainly a useful number of stocks that have been doing that and are likely to continue to do that. Or do you want to take or settle for a low single-digit total return, in some cases, and I'll show you an example, even negative total return, but it pays a dividend? That's what I want to explore. So let's go and look at some key charts. And we'll start first of all with Telstra, the 5-year average return on Telstra. So again, just to remind viewers that is capital gain or loss plus the dividends. So the 5-year average total return is running at 3.4% per annum for Telstra. Now, if we look at the dividend path, in 2012, they were paying 28 cents a share in dividend. That increased to 31 cents by 2017, and it represented around about a 7% yield in 2012. So it was good at the time. But from there, the dividend just fell off a cliff. And from 2019 to 2021, it was down at 10 cents a share. And then from 2022 to 25 forecast, it is now just starting to increase again a little, but it's still only 13.5 to rising to, if the forecast is correct, around 18.9 cents per share in the financial year that we're just about to enter. Now, the yield looks okay, 5.4% yield, but you've got to look at the whole. And if you look at it from a capital gain point of view, you could have bought Telstra in June of 2012 for $3.69. It now trades at $3.52. So you've actually made a very slight capital loss, and you've had your dividend that you thought was going to be, a good cushion against inflation. Well, you've seen that fall from 30 cents to 10 cents. So you've got to be careful what you think is attractive, and you've got to get away from just doing the same old thing all the time, because the market is evolving very, very rapidly, and companies like Telstra have been left in their dust many years ago. So the question is, how will you accent a decent return, total return, and also a growing dividend stream? Because you need that dividend stream to be growing. Otherwise, you're just losing ground rapidly against inflation. Let's look at another. And by the way, Telstra, this is not the sort of stock that I've ever recommended, nor would ever recommend, and neither is Lend-Lease. And there are many, many others. In fact, I would say with confidence that there are far more stocks like Telstra and Lend-Lease in the top 100 than there are the sort of stocks that I focus on, and I'll show you a couple of examples of those in the next two charts. So if we look at Lend-Lease, the total return over the last 5 years has actually been negative 13.5% per annum because the share price has declined so dramatically. In 2012, they paid a dividend of 38 cents. By 2014, that dividend had risen to 71 cents. Okay, everything looking all right. But now that dividend is down to 16 cents. So what looked to be a good investment in 2012, 2014 is now looking like an absolute shocker. So that's Lend-Lease, another stock, along with many others that I have never nor never would recommend. Let's look at what I do recommend. Goodman Group is just one example. And these aren't recommendations. These are just examples of a different way of thinking about how you can get your income. The 5-year total average return for Goodman Group is 21% per annum, which is a very attractive long-term return. In 2012, the company was paying a dividend of 18 cents a share. In 2024, the dividend is expected to be 30 cents per share, and it's risen every single year. It has not taken a backward step. And the capital growth is about tenfold. You could have bought Goodman Group in 2012 for $3.55. It's now worth $35. So that's an excellent period of 10 years of both capital gain and also dividend growth to more than offset inflation. So this gets to the heart of the point of this video. If you want an income stream, why be so fixated on an actual dividend stream? Why don't you just sell a few shares every 6 months? Achieves the same thing, puts money in your account. So why give up the opportunity for a very strong long-term return and a very strong long-term total return, which is what I think investors should be focusing on, not just focusing on stocks that pay a dividend, because many stocks that pay a seemingly attractive dividend are actually dividend traps. They're going to be stocks that look like Lend-Lease. So why give up that strong long-term return opportunity? This is the type of stock that I focus on very, very heavily and recommend strongly to members. It requires heavy immersion in the market to be able to pull this off consistently over time, but that's what I do, and that's what I've been doing for 3.5 decades. Let's look at another. Pro Medicus, PME. The 2024 dividend is 39 cents a share. Now, that's only a 0.3% yield today, and so that would turn many investors off, that it would just be totally inadequate if you were a dividend investor, and so they would just pass on a great stock like PME. But if you look at that dividend on what you could have bought the stock for in 2012, which was about 40 cents, then it's only 100% return a decade on. If we look at 2012, the company was paying a dividend of 1.5 cents a share. It's now 39 cents a share. And the capital gain has gone from 40 cents to $127, a 320-fold capital gain. So the key here for these type of investments is to get highly assured growth. That's what you should focus on. If the company also pays a growing dividend stream, then, okay, that's a bonus. It's a nice bonus. And if you leave it go long enough, it could be quite a significant bonus. But if you focus primarily and firstly on the dividend stream, then you are doing yourself a great disservice. So that's all well and good. Looking back over the last 10 years, a lot of people would think, well, okay, that's nice, but we've missed the boat. But there are going to be, and there are, the next PMEs out there. So where else are the next type of high-growth, long-term wealth compounding stocks like PME? And the answer is that in the very early days, it's very difficult to say with any level of confidence that that stock is going to be a wonderful investment. But what you can do is build into a selection of highly promising candidates, build into them progressively over time with a long-term plan, and then give it the time to unfold. Give it 5 or 10 years to unfold as long as the story remains intact. Now, what are the attributes that these kind of stocks exhibit? And these are just a few, but these are some of the more important big picture attributes that all these kinds of stocks like GMG and PME and others, they all have. They've got a strong niche and they've got a huge runway for growth. They're the first couple of things. The people that found them and run them have shown themselves to be visionaries and have shown themselves to be great innovators over time. The service either tends to solve a pressing problem or it dramatically improves efficiency for their customers. They almost become an indispensable part of their customers' business. I always like to see founders that have got plenty of skin in the game. And in the case of PME, the founders still own something like 50% of the shares. And you also find that they tend to be outstanding capital allocators as well. They know how to generate a good return from shareholders' capital because they're one of the shareholders. So if you look at PME, it's been an extraordinary long-term investment, but there are others that are now emerging. There are others that are of the ilk of PME. So it's not like this is just a one-off. This is far from a one-off. And even if you'd bought in June of 2019, you could have bought PME then. So that's 5 years ago. That is at $21.50 was an entry price in June of 2019. The capital gain has been 490% or $105.50 per share. The company has also paid dividends, total dividends in that time since 2019 of $1.18. Okay, it's not at all earth-shattering, but it's a nice bonus. But based on that 2019 buying price, that yield is now 1.8%, but it's growing strongly. So you give that another 5 years, and that dividend stream will be quite significant. So do not dismiss stocks like PME and GMG. You've just got to widen your thinking and take in a longer time frame, because if you are buying growth, then all things are possible. If you lock yourself into a dividend as your priority, as in stocks like these and dozens of others, then you're going to end up with very poor long-term investments. This is an opportunity that everybody can take advantage of. However, if you're not immersed in the market, as I am, it's very difficult to, first of all, identify these stocks and stay on top of them, and to retain the conviction to stay with them. The services that I offer, the Insiders Club, which is our flagship service, and that's where most members find themselves. They either start within Portfolio Analyst and they graduate to the Insiders Club, or they go there straight on. Another alternative, if you want to explore my methods first and access a huge archive of learning, is Portfolio Analyst. It's available for a 2-week trial for $1. So they're the options. I would recommend that whatever way that you choose to generate your income, that you widen your scope of thinking. Best of luck with your investing.